Good afternoon, ladies and gentlemen, and welcome to the Old Mutual Q1 Voluntary Update. All participants will be in a listen-only mode. There will be an opportunity to ask questions later during the call. If you should need assistance during the conference, please signal an operator by pressing star then 0. Please note that this event is being recorded. I will now hand the conference over to Langa Mantele. Please go ahead, sir.
Thank you, Tene, and welcome and good afternoon to everyone. Thank you for joining us for the Q1 voluntary update as introduced. Effectively, this also serves as our pre-close call as we'll be moving to our close period at the beginning of July. On the call today is our Group CEO, Yuri Stradom, who will lead the discussions on the call with you today. He is joined by Casper Troskie, the Group CFO, as well as Ranen Takudin, who is the Group Chief Risk Officer. With that, I now hand over to you, Yuri. Thank you.
Okay, everybody. Great to be with you. Langa, I guess we'll point to the operating update that we put out on Thursday close of business. So maybe what I'll do is just do an overview of the key issues and then I'll hand back to you, Langa. We've got, as Langa pointed out, we've got Casper and Ranen here with us as well. I think from my perspective, as a kind of Q1 check-in, very comfortable with the progress. I think solid progress in the business on things we've undertaken to do, which is to create structures where we can really track and drive execution. I think Q1 was operationally a very active quarter for us to kind of embed those disciplines in terms of granular targets and holding people accountable for those targets in the key areas. And doing it, embedding it into the across the 5 clusters and deeper down into the business units within the clusters. So I think significant progress made and a significant body of work done. I think on the capital side also, very clear capital discipline, and notably the completion of the share buyback, which we're obviously pleased with, but more than that, I think the kind of internal capital disciplines around applying our framework and very comfortable with progress. I mean, it doesn't always come down to proof points. So we try to direct the events community to the key proof points in the operating updates. And those are the things which we've been flagging as key indicators of success. I think on the sales side, pleased with Q1, flagging whilst the life APs are 28%, flagging it on a normalized basis. When one takes out the big corporate risk deal, it was 15% up, which we were still pleased with. I think that's strong growth. Also comfortable with the other growth metrics across the business, and that it indicates a building momentum across the group. I think if you look at expenses, we haven't disclosed expense numbers per se, but we are indicating that we think that the discipline and the management actions are on track for us to meet our commitments that we gave to you for 2026 and for 2027. I think on consistency, whilst the management actions are on track, just flagging that we changed our assumptions last year. We think our assumptions remain appropriate. But we are working towards ultimately improving consistency and creating a positive variance on those assumptions. And I think we're not yet seeing that coming through, and we do see pressure in the market. So that remains the area clearly of management focus. And then on the bank, we continue again as per the progress we reported at the end of last year, continue to show progress, satisfactory progress on clients, client take-up and deposits. And obviously the focus there on this is a very important year for us in terms of execution in the bank, in terms of rounding out the value, the transactional banking value proposition, and of course driving transactional activity. We are on track with the integration of OMF into AM Bank branches, the lending operations and so on. So very comfortable with where we're tracking with that, and we think that that's going to put us in a very strong, it's a very important part of the success of the bank going forward and its strategy. So I think that's as far as those key proof points are concerned, and I suppose I'll close by just pointing to solvency and group solvency. at the end of Q1 compared to last year, and a lot of that got to do with market conditions that also shows it. Douglas?
Thanks, Rudy, with that brief overview. Dene, if you may just remind the participants on the procedure to put through the questions. And I would just flag that we will take 2 questions per person. If you may just briefly introduce yourself and move straight to the 2 questions. With the preference of putting the questions through on the live call, this is more efficient for us to handle questions that way. Dene, just a reminder. Thank you.
Thank you, sir. If you would like to ask a question, please press star and then 1 now. If you would like to remove yourself from the queue, please press star and then 2. Again, to ask a question, please press star and then 1 now. The first question we have comes from Michael Christelis of UBS. Please go ahead.
Hi, good afternoon, Yuri and team. Thanks so much for the time and the ability to ask questions. My first 2 then, I guess, if I'm only allowed to. Firstly, can you talk a little bit about the bank traction since you started marketing? I think you told us you were going to start sort of above the line and advertising, etc., towards the end of March. I'm just trying to get a sense of, what is that run rate of customer traction done, essentially since that period? Has it stepped up materially? And then I guess the second one is around your excess capital position of 4.2 billion. Can you just remind me whether that's pre or post the investment into the bank for this year? I think you did make a capital investment into the bank, if I'm not mistaken, earlier this year. So I just want to understand how much of that 4.2 is kind of real excess over and above what's earmarked for the bank. Thank you.
Mike, maybe just from my side on the bank question, we actually the above the line is actually only really it's gone on Q2, and in fact, actually in the last 2-3 weeks, there's been a bit early to tell what the customer traction is, but I think working on the sort of growth in the book as you're seeing from December to Q1 is a sensible trajectory to work on.
Great, thank you,
Michael. On the discretionary capital, of that amounts of the 4.2 2 billion of that will go into the bank for, we normally capitalize a portion at the end of the year. So 2 billion of that is for, now in the middle of the year, we'll be capitalizing a portion, and at the end of the year, we'll capitalize for 2027. So those are so you need to take that off the 4.2, which would give you then a more accurate position.
Michael, also
thank you very much. I'll jump back in the queue. Thanks. Yeah.
Michael, sorry, just one quick point. We also 900 million of the share buyback occurred after the 31st March, and so it's part of that 4.2 billion balance. So you need to adjust for the completion of the share buyback as well. Thanks.
Thank you.
We may take the next set of questions.
The next question we have comes from Warwick Bam of RMB Morgan Stanley. Please go ahead.
Good afternoon, Yuri, Casper, and Ryan. Thanks for the time. You carried your commentary around persistency with, I guess, natural caution around fuel inflation and the cost of living. But your base is very low, given the provisions in the prior period. I mean, how are you feeling about the trend? You spoke about improvement to date and being on track. I mean, how do you feel that it progresses for the rest of the year? And then just in terms of the VNB, obviously quite strong mix impacts, but you've managed to lift it to 1.6. How should we think about mix impacts for the rest of the year? Could it continue to rise from here, or is there something for us to think about from the first quarter? Thanks.
Thanks. Back to you.
Warwick, I'll start with the VNB. I can also give some comments on persistency. But on the VNB, if you normalized for that corporate deal, we didn't give you a indication in the SENS announcement, but if you normalize for that, we would have been doing slightly better than last year, and that was because we had a better VNB in National Foundation. We also had a big contribution from Wealth, which helped, and that was offset by PS. It was down a little bit. But slightly better than what you saw at the year end for that quarter. And then obviously as the weight of the corporate deal reduces relative to the other business units, that's what will pull it back to that more normalized number over the course of the year, unless we do another corporate deal, in the rest of the year. But hopefully that helps with the VNB. On persistency, as Judy said, we're still working on the management actions, and that's going as planned, but we are still seeing persistency being worse than what we had hoped for. So more work to be done in that space, and there is an element of affordability that we're seeing across the industry. You look at a lot of the lenders that have been pulling back on lending, so we are seeing pressure on consumers. So that's the comment on persistency.
Thanks, that's helpful.
Thanks, Caspar.
The next question we have comes from Senamile Maveve of SBG Securities. Please go ahead.
Thanks. I just have the one question. Obviously, you would have seen the 3 billion share buyback being completed, with the regulatory solvency ratio now comfortably at 186%. How is the board prioritizing that excess capital allocation for the remainder of 2026?
So I think we remain committed to the strategy that the board approved strategy that we took to the market last year, where we discussed how we think about capital allocation in our horizon-based framework. So whilst ProNAV is below our target level and we're trading at a big discount to what we believe the intrinsic value of the share is, we will prioritize capital returns to shareholders as part of what we consider. And that remains what we are looking to do. We have seen extraordinary volatility in the capital ratios in the last 6 months. You've seen that across most of the insurers, where we saw capital ratios decline, towards the end of last year. We've seen a strong recovery based on interest rate movements. So we're doing a little bit more work internally on making sure we're comfortable with the volatility we're seeing, but that doesn't detract from what we've communicated to the market. We remain committed, as I said, to preferring returns to shareholders while the conditions I mentioned earlier prevail, and we are still working on optimizing our balance sheets. The commitments we made previously, those remain.
Thank you. Thank you. The next question we have comes from Jared Houston of All Weather. Please go ahead.
Afternoon, team. Just checking you can hear me.
Yep.
Yes, we can hear you, Jared. Please proceed.
Perfect. Just 2 questions from my side. The guidance and the commentary alludes to you guys being on track in terms of the cost-saving initiatives. Why don't you just remind us how we will see that come through the income statement in terms of the timing of when we will see these expense savings realized, and will the expense savings be largely backdated into this year and 2027. And then just my second question, we are a long way past the March end period now. If you can give us any guidance on April and May in terms of broad trends in either RFO or investment returns, just to give us a steer into the pre-close as we head towards June here. Thanks very much, guys.
Thanks. I'll go on the expenses. So we told you at the year end that we will give you a proper reconciliation of what we call net expenses at each of the reporting periods. So we showed you the number of roughly 450 last year as the expense saving. Our commitment this year is for 1 billion of expenses. You're going to see that mostly in the businesses excluding personal finance and license savings. We have some expense pressures in the license savings business, which means that you'll see the savings and the uplift in VNB mainly coming through in 2027. So, and not in 2026. But you will see quite visible traction on OMAR, the central functions, and the rest of our businesses where, we took quite a lot of action already in 2025, and you'll start seeing that visibly come through in 2026. We will have an improved savings number from what we showed you at the half year by the time we get interim. So we've still got a bit of time to get those numbers in place, but we'll be able to give you an update at the end. And we still, as you said, we're confident that we'll meet the cost savings for 2026. On the guidance, unfortunately, there is it's difficult for us to give more information than we've given you in the sense. So we have to stick with what's in the sense. We can't give you more guidance than what we were really providing.
Thank you. The next question we have comes from Francois du Toit of Anchor Stockbrokers. Please go ahead.
Hi guys, thanks for the chance to ask questions. Just first one on the 10X transaction. I think it concluded in January. Can you confirm that the flows you've spoken about, gross and net, includes the 10X flows as well? Can maybe just give a little color around that and how the transaction's panning out for you. And then second question, maybe a bit of color also around the large risk deal. Was it a single premium bulk annuity? And also what the margin impact of the deal itself was. Thank you.
Yeah. So Francois, it was a recurring risk deal that we did. And we can't quote the margins. You have to work backwards. This puts us at risk from a competitive perspective. So but it was a recurring risk transaction. Large recurring risk transaction.
Okay, thank you.
First on 10X, that deal went through. I'm just trying to check now the exact date to confirm the effective date, but certainly in Q1, and yeah, very comfortable with the progress in that business. So yeah, it's continued momentum, and yeah, now the work has begun in earnest for embedding the business and extracting the synergies.
thanks. And the flows you've disclosed, does that include the 10x flows as well?
The deal was done, Francois, at the end of the first quarter. So we finalized the deals just as when we went to market, which would have been mid-March. So there won't be much in the first quarter.
Yeah, I would expect it not to be there. It was mid-March, I think, approximately.
Yeah.
Excellent. Thank you.
Thank you. The next question we have comes from Saizan Lakni of HSBC. Please go ahead.
Hi there, Saizan Lakni from HSBC. Two questions from me. The first, you provided a run rate of the RFO about 2.5 billion in Q1. Is there any sort of seasonality, anything to think about in terms of how that should play out for the rest of the year if we were to annualize it? And the second question, coming back to persistency, I'm just a little confused. On one hand, it seems like the management actions are working. On the other hand, you're talking about deterioration persistency. So I guess all in all, did you make an allowance for any sort of worsening of consumer experience within your persistency assumption? And if where we are today, if it was to continue, should we expect positive experience variance? Thank you.
Rana, if you want to comment on the persistency variance question.
So in our persistency assumptions, we took the basis changes through at the end of last year, as you're aware. In that, we factored specific management actions. Those management actions are largely related to operational delivery within the business. And so it does take a bit of time before one sees the impact of that coming through in the operations. So we are monitoring that closely to see whether those deliveries result in an improved persistency outcome and with an intent that we can in time get to positive variances. However, we are experiencing some headwinds with customer disposable income. So at this stage, we are seeing that there are slight negative variances on our persistency, but we do expect to see it improve over time. Thanks.
Just on the RFO, I mean, we gave you a rough indication of what's happened in the first quarter. We've seen quite a lot of volatility in markets, and our business is sensitive to that. So I wouldn't want to sort of give you a full year forecast. But the first quarter there was quite a lot of downwards pressure on indices. So it would depend what happens the rest of the year. If markets recover, I'll feel more confidence that we'll see obviously better earnings, but it's a bit complicated to try and give you a full year estimate at this point in time.
Thank you very much.
Thank you. The next question we have comes from Asande Noche of Mazi Asset Management. Please go ahead.
Hi, good afternoon. I hope you can hear me.
Yes.
Okay, thanks. Two questions, thanks. Firstly, what was the sort of associated or the PVNBP over the period? If you can share that, please. And then secondly, just on a more general note, in terms of your sales mix, how much of your sales mix generally is from your tied agency force versus third parties or like IFAs and sort of non-tied? Please, thank you.
I think I don't have the numbers in my head, so if it's okay, we'll circulate that detail to you, to everyone on the call post the meeting, just to give you that split.
I think this is a sphere. I think in the mass markets, it's almost entirely as tied models, whereas versus in the PF and the wealth segments, it's much more of a balance between tied and the IFA market.
Thank you. The next question we have is a follow-up from Michael Christelis of UBS. Please go ahead.
Hi, guys. Thanks. Sorry to hop on the RFO question, but if I look at last year, and you say Q1 this year, 2.5 is very similar to last year. That means Q2 last year was also about 2.5, but you made massive assumption changes in Q2 that affected your onerous contracts. So I'm just trying to understand what was like the reason for the very strong Q2 earnings last year, excluding those assumption changes. I don't know if I'm making any sense, but I think I am. And then secondly, just on the large flooding in the Western Cape that we saw in May, just trying to get an understanding, are you expecting a material sort of hit there on claims? Is there anything we should be factoring into our numbers in terms of a material deterioration in underwriting because of those two events that happened? I think there were two storms a week apart. Thanks.
Okay. Michael, I'll actually come back to you on the second quarter earnings. So we obviously, whilst we didn't disclose what our earnings were last year, we obviously know what it was. So as I said, it's in line with the prior year, the first quarter earnings. And we'll come back to you on what drove the second quarter earnings. I just need to go and look at that detail. And then, we're not, I'm just looking at my colleagues to help me that I don't, but we're not expecting a large knock from the, flood related claims.
I think everyone across the market will have some exposure in the Western Cape, but I think it's too early to signal anything definitive, Michael.
Great, thank you.
Thank you. The next question we have comes from Tsapelo Mokanyane of Investec. Please go ahead.
Good day, Tsapelo from Investec here. Just two questions as well. Part of the persistency question has been answered, but I just want to get a bit of sense. I mean, have you seen that persistency worsen towards the latter part of the quarter, or has there been like consistent sort of persistency trends throughout the quarter? A bit of color with regards to that. And then the second question is on the switch from guaranteed to market-linked annuities. Do you have a view of how that trend sort of goes from here, given where interest rate levels are? And in this quarter, I appreciate the fact that you said it continues to exert pressure on margins. But is it the same level of switching that we've seen in previous periods, or have you seen a bit of an improvement?
Maybe just a comment on the persistency. I don't think we're signaling intra-quarter trends. I think it's more just an observation. Maybe going back to the earlier question, to be clear, I do think we have in our engagement said, whilst we took the assumption changes last year, we were looking to get the impact of management actions into a positive variance. And I think that's what we're really signaling, is that there's headwinds to that. But I think that's not I don't think we're signaling at all a kind of intra-quarter negative trend on it. I think on the annuity question, I'm not sure that it's trending anywhere now. I think that it is now where it is in terms of the balance between annuity, guaranteed annuities versus market linked. And I think the view is across the market, it will really only reverse when bond yields with reverse. It's in line with that, with that change that's taken place over the last 18 months to 2 years.
Very clear. Thank you.
Thank you. The final question we have comes from Brad Moorcroft of Peregrine Capital. Please go ahead. Brad, your line is open. Unfortunately, we have no response from Brad's line. At this stage, there are no further questions on the conference call, sir.
Thank you, Daniel. I'll hand back over to you, Yuri, to wrap up.
Okay. Thanks, everybody. I think to sum up, I think we are comfortable with the progress we're making across the business, and look forward to engaging with you at insurance. I think that's probably our next stop, Langa.
Yes, it is. Thanks, Yuri. Thanks, everyone, for joining the call.
Thank you. Ladies and gentlemen, that then concludes today's conference. Thank you for joining us. You may now disconnect your lines.